Good afternoon, and welcome to the weekly market update for the week of November 7th. Equity markets lose momentum amid policy and data uncertainty. U.S. equities returned negative 1.61%, with sentiment and momentum fading midweek as tech valuations came under pressure following Palantir's results and Burry's short positions, compounded by mixed labor data and the prolonged government shutdown. Canadian equities returned negative 1.21%, with early gains from an infrastructure-heavy budget offsetting later losses from stronger-than-expected jobs data, weighing on rate cut expectations. European stocks fell negative 0.67%, drifting lower as the Bank of England held rates with dovish guidance amid rising inflation expectations, while corporate earnings delivered mixed signals and fiscal uncertainty weighed on sentiment. Emerging markets were down negative 0.76% lower, despite an easing of trade tensions pushing Chinese equities into positive territory. Broader emerging markets were mixed, with Mexico's rate cut highlighting growth concerns. Soft data and strong jobs result in a week of repricing. The 2- and 10-year U.S. Treasury yields fell 5 basis points and 1 basis point, respectively. In Canada, the 2- and 10-year yields were down 4 and 3 basis points, respectively. Bond yields and prices move inversely to one another. Government bond markets were mixed, with U.S. and Canadian yields rising on stronger employment data, while UK gilts rallied over dovish Bank of England guidance, and Eurozone benchmarks remained range-bound amid steady macro releases. Credit markets saw wider spreads as elevated primary supply and risk-off sentiment weighed on performance. Investment-grade insurances surged midweek, while high-yield bonds struggled despite stable premiums. Purchasing Managers Index shows Canada's service sector expands for the first time this year. The new business index was in contraction for an 11th straight month, even as it improved to 48.8 from 48.1 in September. The employment measure was at 48.5, down from 48.9 in September, and the Future Activity Index slipped to 60.8 from 62.2. The S&P Global Canada Composite PMI Output Index rose to 50.3 last month from 46.3 in September, marking its highest level since November 2024. U.S. factory activity contracts at a faster pace as production lags. With the reading still below 50, it points to contraction in activity in the sector for the 8th month in a row, though a score above 42.3 in the index generally tallies with expansion in the wider U.S. economy. While there were gains in new orders in August, followed by production in September, those short gains didn't appear to translate to sustained growth for the sector, a reflection of continuing economic uncertainty according to the report. The data also showed the index for production, in particular, fell into contraction after growing in September. New orders and employment also contracted in October. German factory orders rebound after recent slumps. The easing of trade uncertainty was reflected as foreign orders of German goods outside the Eurozone rose faster than those from inside the currency area in September. Meanwhile, domestic orders retreated, Distasis said, despite hope that Germany's new injection of government funds for infrastructure and defense could boost industry. Despite the positive numbers, Distasis said there still remains little sign of sustained recovery in demand for German industrial goods. Thank you for watching and have a great week.